All right, so go ahead and ask your question again.
Can you explain that and what you're doing on Friday?
Yes. Why am I making the 2 entries? Now, remember, it all hinges on the fact that the end of the month falls on Wednesday. Midnight Wednesday. And as of midnight Wednesday, I owe my employees for 1, 2, 3 days. So at that point, I have to make an accrual entry on my worksheet to get that expense in the month of May. So I make this entry here. Debit to wages expense for 3 out of 5, right? 3 days out of 5 of the $1,000. So it's $600. And I record it as a liability because I haven't paid him yet. I haven't given him the cash. So I credit a liability account, wages payable, for the $600. And again, I'm just setting that money aside so that later on when I do give them the cash, I don't have to record it as an expense twice. Okay? So then on Friday, the end of the week when they normally get paid, 2 more days have happened, and I owe the employees for that. Okay? So I want to record that amount. That would be the other $400, because it's 2/5 of $1,000. So I have more expense, wages expense that I've incurred, $400. But I have to give them $1,000 in cash, right? Because for the whole week they earned $1,000. So I take this wages payable, this amount that I've set aside as a liability, and I reduce its balance to 0 to make my debits and credits balance when I reduce cash by $1,000. Okay? Are you with me? Everybody with me so far?
I understand the whole part, but why would you want to do that? Why can't you just let it run?
Okay, it's the matching principle. So think about it. If I took that $600 that belonged in May and I didn't record it, okay, I'm going to throw a hypothetical at you here. We have, this is May. I have revenue. I have expenses. Revenue minus expenses gives you net income, correct? So I'm doing a very simple income statement here. If my revenue is $10,000 and my expenses that I record are $9,950, what's my net income? $50, right? Okay, and this is an extreme case, and I'm doing it on purpose. So I don't record the 3 days of May, and my income statement shows a net income of $50. Did I really make money that month? No. It doesn't reflect the true economics of what happened. So by doing that, let's say we go to June. And the same thing happens. We have $10,000 in sales. Okay? And we have $9,950 in expenses. Again, I go, hey, look, we made $50. Did I really make $50? Well, I've taken these 3 days in May and recorded them as an expense in June. So my expenses here are in reality lower than what I've reported, and I made more money, in truth. Over here, I've underreported my expenses, and my net income is actually lower. Okay? So I've moved income from one period to another. And one of the worst things you can do is have a company make decisions. You know, when you're really close to being profitable or losing money, you're making decisions on how do I make this profitable? What can I do? What can I do? And if you think you're profitable but you're not really, you might make the wrong decision. And you could hurt the company. So that's why this is important to make sure that you accrue the wages in the correct period. So we've got to do this calculation and make the entry on the worksheet. Yes, ma'am.
So the entry you do on Wednesday, it's Wednesday, but it's still May, and the one you do on Friday is already in June.
Yeah, this is a May entry, and it's the end of the month. And this is a June entry, and it's in the new month.
And the May entry is done as part of your worksheet.
Worksheet. It's one of the adjustments in the worksheet.
The June entry is just done when you do the salary.
It's just, yeah, this goes on your cash payments journal. Okay? Good? All right. So that's accrued salaries. We're going to get to see some examples. If you're going to accrue the salaries and wages, you got to accrue the taxes that go with it. So, you know, if the wages were $1,000, maybe the taxes are $100. So you've got to split up the $100 and record it just like we did here and break it into its correct time periods. Again, you do that as an adjustment on the worksheet. Okay? At the end of an accounting period, you always stop and calculate the interest expense for the period you're in, for the month you're in. So if you borrowed money from a bank, even if you haven't made the payment, you've got to record that you owe them the interest on it, your cost of borrowing those funds for the month that you're in. If somebody's borrowed money from you, you've earned money just by the sheer fact that they've had your money for a month. So you've got to record that as income. So we now are adding an accrual for the interest, income or expense on money that's borrowed. Yes. I'm going to skip a couple of these because we've kind of done them already. All right. So here's an example. Let's do the example. Oh. We calculated that the 3 days out of 5 wages for this company, 3/5 of the number was $1,200. So you record it as salary expense for the month of May, and wages payable that sits on the balance sheet as a liability that you can use later, right? Then you go ahead and you calculate the payroll taxes. Use the statutory rate. Calculate the payroll taxes, estimate what your employer's payroll tax expense is. What are the employer's payroll tax expenses? Social Security, Medicare, federal unemployment tax, state unemployment tax, what else? What? Workers' comp's not a tax, but yes, you would record that. Federal unemployment, state unemployment, and is there another one? What? Yeah, no, those are them. Sometimes there's state disability. Yeah. Does the employer pay the federal and state tax? Do they match the state and federal income taxes? No, they don't. So those 4 things are it. FICA, Medicare, Social Security tax, Medicare, FUTA, and SUTA. Okay?
So you don't even have to mess with those other taxes because those are just dealt with on.
Those are withheld from the employee, and that's not an employer expense. So we don't have to mess with them. Okay? So we calculated $91.80 over here. You recorded them as payable, Medicare and Social Security, and you record it as an expense, and on you go. Liabilities, current expense in the current period. Goes on your income statement. Then you calculate the unemployment taxes. They're going to show us that. And you make a federal and a state unemployment tax entry. Good to go, right? The book shows you to do these as 2 separate journal entries. If you do them as one, it saves you a little bit of time and effort, and that's okay. Questions? All right. Notes payable. We remember notes payable. We love notes payable. If I have to calculate the interest expense on money that I've borrowed, what's the formula for it? Anybody? Don't all jump at once. The man has it. Interest equals principal times the interest rate times the amount of time that you've borrowed the money. Okay, remember this formula. It's really easy, and I'm not going to give it to you on test day. So if we've got if we went and borrowed $2,000, we'll just make it an easy amount. The interest rate is 12%, 0.12. How long did we have the money? Assuming we do this every month, we've borrowed it for 1 month, this month, right? So what's my interest that I have to record for this month? I borrowed it for 1 month out of 12. We've covered this formula before? Good, okay. I forget because I have 2 classes and I know I've covered it in the other one, so I don't want to make an assumption.
This is flat rate. There's no accruing on the interest.
This is flat rate. This is not a, what? Correct. This is not a daily rate, it's a monthly rate. So an interest rate of 12% is stated, you know, they state the interest rate at 12%. That covers a period of a whole year. So if you borrow this money for a whole year, you owe me 12% interest. Well, I only borrowed it for 1 month, this month, because I'm making the entry. So my time period is 1 month out of 12. If I borrowed it for 2 months, it'd be 2 out of 12. If I borrowed it for 6 months, it'd be 6 out of 12. And you need to do that to modify the interest rate to make it a monthly amount or a quarterly or a semi-annual amount or whatever you're doing. So what's 2,000 times 0.12 divided by 12 is what? 0.1? 0.01, sorry. Yes? Am I doing my math right? So what is that number? It's like 20 bucks, right? So my interest expense for the current month for borrowing this $2,000 is 20 bucks. Somebody with a calculator check me. Did I do my math right? What? Yes? Right on. I got lucky. So again, I'm going to go back to my worksheet now, and I'm going to make an adjusting entry based on this. Can anybody help me out? What do you think my entry is? I have to record interest expense, so my debit is going to be to what? Not all at once. My debit is to interest expense. For $20. My credit is to, is it to cash? No, it doesn't say that I've paid the guy the money, but I will have to pay him later. So this is going to be a credit to a liability account called interest payable. So you have a credit for $20 there. This is the journal entry format, but remember, you're entering this in the worksheet, in the debit and credit columns in the worksheet, right? Everybody follow? This one's pretty simple, pretty straightforward. Questions before I move on? Okay, so we're going to go calculate it, blah, blah, blah. Come on. Principal times rate times time. It's 20 bucks. Oh, look, I did it right. Takes them a lot of slides to cover some of this stuff, so I like to do it by myself. Okay. Some other entries that you might have to make, and these come right out of chapter 5. Prepaid expenses, right? If we prepaid the rent, if we prepaid for supplies, if we prepaid for insurance, we have to go figure out, oops, one too many. We have to go figure out what we've used up, right? So if you prepay $6,000 for 6 months worth of rent, how much did we use up this month? If we prepay $6,000 for 6 months of rent, how much did we use up this month of our prepaid? $1,000. So we've got to reduce that prepaid by $1,000 and record it as an expense. Good? Everybody remembers that. That's chapter 5. Okay. If you nod your head no, I'm going to get nervous here with 2 weeks to go in the semester. We did the adjustment with supplies in Chapter 5, right? You adjust to your ending balance. Prepaid insurance, right? You use that up every month just like you use up rent, same sort of calculation. I don't want to make this class hard, so I'm just going to say sometimes a bank will make you prepay the interest on the money that you borrow. So you would have to calculate what part of it you use up. We're just going to let that one go because I'm not going to make you do that on an exam. But for Accounting 1A, we'll be doing that one. It'll be fun. Okay? Here's a good one. Accrued income. We kind of talked about this before, have we not? A little bit? What is accrued income? Let me give you a hint. Remember our magazine subscription example? We talked about that, right? What? Well, there's two ways that this goes, okay? And this one is going to be exactly what you said. I've earned it, but I haven't been paid yet. The most simple example of that is you have a customer come in that you give credit terms to, you let him pay in 30 days. So he hasn't given me the cash, but I'm going to record that as a sale, as revenue, correct? Another example where you'd have to make an adjustment for it is if anybody's ever worked with construction billing, right? When they have big construction projects, they're based on, there are periodic billings that you can bill your customer based on a percentage of completion. So you don't just send them one invoice when you're all done. You know, at the end of every month you stop and look and go, okay, we're 10% done. I can bill him 10% of the contract amount. Or I'm 50% done, I can bill him 50% of the contract amount. Has he paid me yet? No. But you would record that, whatever that amount is, as revenue in the current month and as a receivable, okay? The reverse of this was my magazine subscription example, where someone's paid us in advance, right? Everybody in here, you subscribe to People magazine, right? You pay in advance for 12-month subscription, and do you get all the magazines right away? No, you get one every month. Did they earn all that money you sent them? Not until they've sent you the last one. So every month they earn 1/12 of the total amount of money you sent them. So you've got to make an adjustment for that every month.
So it sits in a certain account?
If we're the company and someone's prepaid us, that's a liability until we perform on the service. Okay? So there'll be a credit somewhere in a liability account that will go down every month towards zero as we earn the money. And so our adjustment would be to debit that account and credit revenue.
Because you already have the cash, so there's no nothing.
Yeah, cash, there's no more cash coming in the door because they've already given it to us. Okay, so accrued income is money that we've earned but not yet received. This is in its most simple case, this is where we've given a customer credit terms and they're going to pay us in 30 days. Okay? Or the construction contract where we've completed 50% of the building so we can invoice them for 50%. Does it mean they're going to pay us? No, it's still a receivable. But you guys understand the simple entry that goes with that, right? Go ahead.
The thing on that last slide that stood out was and recorded. So a sale that someone's going to pay in 30 days has been recorded, so that is not accrued income.
Correct. If a customer comes through the door and they come up to the counter and they buy something and sign the invoice and say, I'll pay you in 30 days, you've recorded it because that gets entered into your cash register or your transaction system. The one that needs to be recorded would be the construction contract. So I'm going to build a $1 million building for Google, okay? And at the end of this month, we're 25% of the way done. I get to record $250,000 as revenue, credit to revenue, debit to receivable under the contract. But no invoice was generated, so I need to enter it as an adjustment because it hasn't been recorded yet. Good?
And same thing with the magazine subscription. It
Yeah.
hasn't been entered.
That's the flip side. That's unearned revenue, where we've been paid, but we haven't performed yet. Okay? Good? Confusing? Anybody? Yes, ma'am.
So is this only for, like quotes or contracts that have been given out?
This is the one you'll probably see the least out in the real world, unless you get into some of these unique industries where you are billing under these big contracts that go on over long periods of time. But I do want you to know it exists. But yeah, this would take a big contract that's going to go on over a long period of time, multiple accounting periods.
So if a retail company has like all these purchase orders that they have placed, but they don't have any,
Okay, a retail company places purchase orders with a vendor. You don't have an expense until you take delivery of the goods, but that's an expense. That's not a revenue at all.
oh, so the other way around, then,
If you're the retail company, you've neither invoiced your customer, received cash, because you haven't performed on that purchase order yet, so you don't have an entry either. Okay? Again, this is going to, the only thing I can think of off the top of my head is a big construction contract where I get to bill you partway through construction of the bridge, the building, the highway, something like that. Okay? Because if I'm going to build you a bridge, it's going to take, maybe a year and a half. So I get to, record the revenue every month along the way because I'm earning it every month. Because I've incurred those expenses, I've paid my employees, I've paid for fuel, I've run my equipment, and I'm going to depreciate it. And if you didn't do this, if you didn't accrue the income for the percentage that you'd finished, you would have all these expenses with no revenue. So you're losing money, you're losing money, you're losing money, and that's not the truth of what's going on. And then in that last month when you finish, you would have this $1 million revenue with only 1 month worth of expenses. So you'd have a whole bunch of net income after having months and months and months of losses. And this is designed to fix that. Okay? All right. Notes receivable, we calculated that on the board, right? Principal times rate times time. This goes two ways. If you borrow money from somebody, you owe them. So you've got interest payable and interest expense. If someone's borrowed money from you, you've got interest income and interest receivable. So you could potentially have both entries in the same company. Okay? Okay. This is the flip side of what we were talking about, unearned income. Someone's paid you the money, but you haven't performed yet. So the subscriptions is a perfect example. Thank you. Subscriptions is a perfect example of this. Someone pays you, $100 for 12 months worth of People magazine. You earn 1/12 of the $100 every month when you send them another, I was going to say episode in the mail, right? Another magazine in the mail, okay? So you'd be making an entry every month to, we'll show you an example in a second. This is the flip side of what we focused on back in chapters 4 and 5, where we had prepaid rent, and we would record the expense, the debit to the expense, and reduce our prepaid asset every month. If we've prepaid any construction fees, or if someone's prepaid us for construction fees or legal fees, right? What do attorneys always want? A retainer. They want your cash up front. So this happens to attorneys all the time. You've paid me cash, but I haven't performed yet. When I perform and I keep your money, then it comes out of unearned revenue and it goes into revenue. I want to throw an example up here on the board. Subscription, magazine subscription, right? And we're going to make the numbers easy. It's $120,000 or $120 for 12 months of People magazine. Okay? $120 for 12 months of People magazine. We write a check, we mail it off to People. They cash the check. What's their entry? What'd they get? Cash. Cash goes up 120, and they're going to debit unearned revenue. 120. Unearned revenue is a liability on their balance sheet, saying that I owe this money to someone else. That person could ask for a refund because I haven't performed yet, and I'd have to give it back to them. At the end of month 1, People magazine performs, they stick an episode in the mail, right? An issue in the mail. They now get to debit unearned revenue for, how much is it? Sorry, $10, right? And they get to credit revenue for $10. Notice this is the first point at which I actually have revenue or sales for my company, is when I've actually performed on the contract. Yes, sir.
A business that uses a bunch of this is likely to have a subsidiary with every account, every customer's information.
Yes, you'd have an account payable, or you'd have a customer, prepaid customer subsidiary ledger. Yes. I'm trying to think of the right words that I'd call it. And all that would be is a list of all the people that make up the balance of my liability, who I have to send those issues to, magazines to. Yes, ma'am.
I don't know if this makes sense, but so, like in a perfect world, a company wouldn't spend the $10 until it's in a revenue account? Like, is the unearned revenue
No.
the money just put aside?
Unearned revenue is set aside, okay, because it is a liability, but the cash goes in their bank account and they can use it, okay? They can pay current expenses with it. They can pay, wages, rent, insurance, all those things. The downside to that is you as the customer have trust that they're actually going to come through and perform on their end of the bargain. Have you ever heard of a company that goes out of business? Trying to think of one that I've seen recently locally. Oh, there was a day spa that went out of business here locally a couple years back, and it made the news because they had sold a bunch of gift certificates to people. You get a massage anytime you want, come on down. And they took people's money and they gave them a certificate for the massage, and then they went out of business and locked the doors. And those people didn't get the massage. Did they get the money back? No. Gone.
I wonder if those are the same ladies that tried to hustle me for a certificate.
I don't know. I don't know. But you have to have some faith that that company is going to be around to perform on their end of the bargain. Okay? Because the cash is not restricted. They have an unlimited right to do whatever they want with it. They can spend it on current expenses, even though they will have future expenses in order to perform on your magazine subscription. Okay?
And those ladies would be held liable in a civil lawsuit.
They could be. In this example that I'm remembering from our local news, I don't remember hearing that anything ever happened to them.
I thought they gave everybody notice of this thing as they gave, there was a thing in the paper that says if you not get a certificate, you had to go and use it.
No, this one didn't. No. But what I recall happening is there were a couple of other day spas that stepped up and said, we'll honor those gift certificates, even though they never got the cash. And what it is they're trying to bring in future customers for themselves. So, but you know, people got hurt, is all I'm trying to point out, because there's no restriction on them not spending the cash.
Do you know which one it was?
I do, I'm not going to say.
Is it Muslim?
No. See, now we're narrowing it down. Well, let's play 20 questions, yes. Okay. For doing that, by the way. So before I go on, what we've done here with chapter 12 is talk about the types of adjustments, you know, the type of adjustments that we've talked about throughout the second half of this class. Interest, income, interest expense, things of that nature, and these other accruals. You guys do remember how to make those entries in the adjustment section of a worksheet? Do we want to go over that? Or is everybody comfortable with it? We're going to do one. Press Shift F5. Shift F5. Okay. Oh, that.
Watch from the same slide.
Yep. Okay. Thanks for that. That's a good one. We're not going to use, that's chapter 13. We're not going to look at that for a minute. So just as a brief reminder, remember a worksheet is simply a trial balance. A trial balance is all of your chart of accounts in order, starting assets, liabilities, owner's equity, revenue, expenses. So I'm going to make a simple, very simple chart of accounts. Cash, accounts receivable, accounts payable, owner's equity, owner's capital account, right? I'll just call it capital. Revenue, expenses, okay? But you'd have all the detail in here. And then you would have a balance for each account. Debit, credit. So cash typically has a debit balance. Accounts receivable typically has a debit balance. Accounts payable typically has a credit or liability balance. Capital is a credit balance. Revenue is a credit balance. Expenses are a debit balance. And I would plug capital to make this work. 2, 3, 4, 2, 25, $1,500 in capital. Okay? I'm in balance. Good? Everybody's buying that? Then on your worksheet, you would have your adjustments. And you'd have debits and credits here. So if you were making an adjustment to, say, cash, because you knew it was wrong, and you had to fix it to match your bank statement, let's say it had to go up $100, you'd record the debit to make it go up, right? Debit plus a debit. And you would have a corresponding credit somewhere else. So notice the total of my debits column would equal the total of my credits column. It shows that I'm still in balance. And then you would have an adjusted trial balance with debits and credits. And you do the math. 1,000 debit plus 100 debit is 1,100. 2,000 debit with no adjustment gives you 2,000. You guys remember how we did that, right? So your original trial balance must be in balance. Your adjustments should be in balance. Your adjusted trial balance, therefore, would be in balance. Good? And it's from that adjusted trial balance that you create your financial statements. There are how many financial statements? How many? 3. And they are in order? Which one do we prepare first? Income statement, statement of owner's equity, and balance sheet. Good. Okay? If you need a refresher, go back to chapter 5 and thumb through it real quick. You'll remember. You guys all did well on the test. The people who didn't aren't here anymore, so I know you're doing okay. All right? Okay, any more questions before I move on? None.